we wanted to make sure is that, we got together with everybody to discuss some topics from a financial planning standpoint. We can't cover every possible topic today. I was glad to hear in some of the introduction that there's going to be lots of sessions on financial planning. We can dive into many different topics, but based on the time we have today, we're going to go just through 2 or 3 topics that we want to focus on. But really, as we've seen the news in the last few weeks, the stock market, what do I do? Are we going through a slight correction? Are we going through a larger dip? Are we heading into a recession? How should that change my 401k strategy or my strategy for saving in a 529? Also in the news, what's going on with changes to government programs? How does that affect my financial planning? And then the overall debt of the country, right? A lot of the changes to programs are due to debt in the United States. We're over $30 trillion in debt. And if we're going to get out of debt, does that mean we have to spend less as a government, or do we have to tax more as a government? Probably going to be a combination of the two. And so if we know these things are coming up, how do we change our financial plan to prepare for those upcoming changes? And so today we're going to talk a little bit about retirement planning and how our tax strategy should be impacted by potential changes in what will be the tax code out into the future. So, today's session will be a focus from that standpoint. We are not trying to give anybody, we're not coming on today just as a disclosure of, what stocks to buy or what stocks to sell. We are talking in general from a planning standpoint of kind of some strategies that would be best suited for most people. Obviously, everybody has their own particular financial situation as far as time horizon goes, as far as goals that they're planning for. So, when we think about financial planning in a group setting, we always talk about common goals and strategies that we have to consider. Obviously, we want to protect our family during our working years. If my income ever stops, whether that's through death or disability, is my family protected? But let's hope and plan for ourselves to, be alive and active for a very long time. So how do I save my money so I can enjoy certain life goals like sending kids to college, or maybe it's retirement? And so when we do that from a financial planning standpoint, what we know for Lakshmi and I, when we work with individual clients, is people are becoming less and less confident that they're going to have enough money to retire comfortably in the future. And what we want to make sure is that people are feeling confident about what they have in as far as savings. So we cannot predict the future, right? And that's one of the big things here. Do I know that I'm going to live until I get to retirement? When I get to retirement, am I going to live 25, 30 years in retirement? From a planning standpoint, it's always hard to determine how long I'm going to live, how much money I'm going to need. And so what we need to do is plan for different situations. What happens if something happens to me in the next few years, or what happens if I live well into my 90s, into 100? Is my financial plan prepared for either of those situations? And when we don't know exactly what's going to happen in the future, what we have to do is diversify a strategy from a financial planning standpoint that says, if something happens to me tomorrow, is my family protected? But also a plan that says, if I live a very long time, am I going to have enough money in retirement to enjoy a very long and healthy retirement? And so what we know from that standpoint is, as we start to save money, what we have to think about is diversifying from a risk standpoint. So when we look at things from a risk standpoint, we have money that is stable and guaranteed, and then we have money that is aggressive, and then we have money that's somewhere in between. So that if I was saving for a house, or for me personally, I have a son who's going to go to school in a year, or college in a year, or if I was only a year or two away from retirement, if I have short-term goals, I can't really be taking risk with that money in the stock market, because if the stock market goes through a correction right before I need the money, that's going to be a problem. So how much risk I take with money, let's say for my son's tuition, which I'm going to need in a year, is a lot different than the risk I would take for my own retirement, which isn't happening for about 18 years, right? if I am saving in my 401k, I'm a lot more aggressive right now than I am for my son's college planning. That goal is 1 year away for college as opposed to 18 years until I retire. So even though there's a correction in the market right now, my retirement plan will have plenty of time to make up for the loss in the market this year over the next 18 years. So we always diversify from a risk standpoint. What we're also getting into conversations about, and what's being talked about a lot more than it ever used to, is also diversifying from a tax standpoint. So for most of us saving for retirement, we'll use retirement as kind of a common goal. What we try to do is use things like 401k plans, 403bs, IRAs, SEP simple plans, depending on who you work for and what type of retirement plan they offer. If for most people they have 401k plans, the great part of a 401k plan is when I put money away into the 401k plan, I get a deduction for the money I put away. So not only am I saving for the future, I'm also getting a tax break today. And that's a fantastic thing. But what happens when I get to retirement? When I get to retirement and I pull that money out, all of the money from my 401k is now taxable. Not just the money I put in, but also all of the earnings I've accumulated over the years. So what I'm doing is creating a tax bill out into the future. For some people, we think, hey, that's fine because when I get to retirement, I'll make a lot less money than I make today. I'll be in a lower tax bracket. But what we're going to dive into today is what happens if tax rates go up in the future. Again, we're a country that's $30 trillion in debt. At some point, taxes may need to be increased in order to pay down that debt. And if that's the case, am I avoiding taxes today in a 401k to end up paying higher taxes in the future? And so since we don't know where tax rates are going, not only are we talk to clients about diversifying from a risk standpoint, we also talk to clients about diversifying from a tax standpoint. So we look at money, we talk about what's our safe money, what's the money we'll need out into the future for retirement, and then also what's the money we want to leave from a legacy standpoint. So I want to leave my kids better off than my parents left me? Do we want to make each generation a little wealthier than the generation before? We're trying to improve our families' lives generation after generation. How do we do that? So we build a plan that allows us to enjoy retirement. Will I have enough money for my hobbies and my travel? And then what about the legacy I leave behind? So as we go through that and consider some challenges, certainly Social Security would play a part in our overall retirement strategy, but also how long are we going to live in retirement? So it used to be when Social Security was first created, 65 was considered normal retirement age. Well, in the 50s when Social Security was created, the average man lived till 65 years old and 2 months. So for the most part, for the government, people were contributing to Social Security throughout their careers. They retired at 65, and the average male was only collecting Social Security for 2 months. So that was a good way for the government to collect a lot of money and pay out very little. Now people are living to 85 and 90. It's not uncommon to hear people living past 90. And so can Social Security survive paying out that many years to people? Will they have to start Social Security later? So how does Social Security get impacted by how long we're living? And then also the volatility in the market. So 25 years ago when I first started in the business, most of our clients had pensions, Social Security, were driving the vast majority of their retirement income. A little bit of personal savings was making up the difference. Pensions have almost gone away for most individuals. Social Security is paying out less after we adjust for inflation. And the vast majority of savings needed from a financial plan are coming from our own savings. So really the risk has shifted from our companies or the government funding our retirement income, and that risk has shifted to us to create our own retirement income. And that's why it's so important. When you work with a professional like Lakshmi, who works and helps you create a plan, because this is your plan, you're going to be responsible to create the income needed during your retirement. And what she does so well, and I work with Lakshmi with many clients, but diving deep with clients of how much will I need in retirement, right? We all have different visions of what our retirement will look for. How much will I need? How long will I need it for, right? And everybody has different family histories as far as health and our own health situations. And so every plan is customized to each family. But it is so important to start that planning as early as we can. And what we're going to dive into today is really the idea of the taxes, how taxes will play an impact on your retirement income, and then also how do they play an impact on college savings. And so if we look at this chart here, I think most of us would agree we're all paying too much in taxes, right? I've never met a client who told me, John, you know what? I just don't pay enough in taxes. I wish the government would take more money from my paycheck. But the truth is, the idea of this chart here is if we look at it historically, we are actually in historically low tax environments right now. And that helps us from, driving corporate taxes, but it helps on the individual side. But if we take a look at this chart here, I always find this one interesting. This is comparing tax rates in 1980 compared to what they were in 2022. And we just use 2022 as an example. So in 1980, if you had somebody who was making $65,000 a year in 1980, they were actually in the 54% marginal tax bracket. Now, I understand inflation changes, where we fit in, what 65,000 a year in 1980 compared to what that means today. But think about that today. If you were making $65,000 a year today, you're actually in the 12% marginal tax bracket. So $65,000 a year in 1980, you're in the 54% tax bracket. Now you're in the 12% tax bracket. What does that actually mean? Well, what that tells us is even though we feel like we're paying too much in taxes, historically, we're in very low tax rate environments. We also have to understand that we're $30 trillion plus in debt in the government. If we're going to pay down some of that debt, what happens if tax rates come up? How do we do planning to prepare for that? And so as we go through, what we do with clients, what Lakshmi and I do when we sit down with clients is we really start preparing a financial plan. And we do that by looking at where you're saving money to get the best tax strategy. And in a very simplistic way, what we do is we break down your savings in 3 different types of buckets. So bucket number 1 is what we call a taxable account. So some of the money I'm saving for the future, I put in what's called a taxable account. The good news to a taxable account is the money I put in is always accessible. If I need some of that money tomorrow, I could always pull it out. I don't get penalized. The bad part of a taxable account is every year I make money in that account, I pay taxes on it. Easiest way to think about that, you're checking your savings account. So if I need money to pay grocery bills, I need money to pay my mortgage insurance, I need money to pay real estate taxes, I have money sitting in a taxable account, I have to write a check tomorrow. This account gives me full access. But the downside is this account's giving me no tax advantages. I pay taxes on the gain every year. So any short-term goal I have, money I need access to, I typically put that money into a taxable bucket. The access is most important. I don't get any tax advantage, but I'm also the most conservative in this bucket because I'm going to need that money short term. I can't really take the risk. The next 2 buckets are more of a tax strategy. So bucket number 2 is what you call a tax deferred bucket. That, for a good example, is your 401k. I put money into that bucket and I avoid paying taxes on that today. But when I take money out in the future, I'm going to pay taxes on it. So again, 401k is a great example. Your IRAs, great examples. I've gotten deductions. I've avoided taxes on that money today, but I'm going to pay full taxes on that sometime in the future. And so because with 401ks, I can't really touch that money till I'm 59 and a half, few exceptions are available. This is where I can take more risk. Since I can't touch the money till I get to retirement, this is the type of account where I would take more risk. Now, on the flip side of that is the 3rd bucket. That's where you have your tax-free income bucket. So that's money where I pay taxes on the money today. So I collect income from my company, I pay tax, then I put it in this tax-free income bucket. And the great thing is once the money goes into this bucket, I will not be paying taxes on that in the future. So whether I use that money, I could set up accounts where I could take money out tax-free for college. I can put that kind of account in a tax-free income bucket. I can put money away for retirement that can come out tax-free. Or I could even put money away for my kids out into the future. So when I pass away, I leave money to my kids and that comes out tax-free. And so if I'm worried about where tax rates are going, this third bucket, the tax-free income bucket, becomes more important. So if we want to dive deeper into these three buckets, I'll give you some extra examples of where these buckets come into play. So again, taxable income, my savings account, I get a CD at the bank. I buy some just individual stocks on, let's say, an E-Trade account. I invest in a business that creates income every year. These are accounts that are accessible. I don't get penalized for taking money out early, but I don't get any tax benefits inside of them. The tax deferred bucket, that middle bucket, 401ks, IRAs, you could talk about annuities or deferred compensation plans. These are places where I'm avoiding taxes today, but I'm setting myself up to pay taxes out into the future. And then finally, the tax-free bucket. So some of the more common places we talk about, Roth IRAs. That's after-tax money goes into a Roth IRA, but out into the future when I get to retirement, I'll pay nothing in taxes on it. Or if I'm saving for college. So I have my daughters in college right now. I have a son who's going to be going to college in about a year and a half. 529 plans, one of the more popular ways to save for college, because what you can do is you can pull money out tax-free from those 529 plans as long as you use the money for college. So people get excited about college savings through 529 plans. Municipal bonds, also a tax-free distribution, and then cash value life insurance. Cash value life insurance is an interesting part of that third bucket for three reasons. One, if I need to take money out of cash value life insurance, let's say for college, for my children, I can pull money out of my cash value life insurance policy and that could be tax-free. Or I could take money out of the cash value of the life insurance policy if it's set up correctly and pull money out tax-free for my retirement. Or the third one, I don't ever touch the cash value life insurance during my lifetime. I pass away and there's a tax-free death benefit to my beneficiaries, whether I leave that to my wife or to my children. So I'm able to leave them money and get the money outside the tax system. So different ways to set up your financial plan. Again, everybody on this call, on our Zoom meeting today, has different goals. Right? Are we saving for college? Are we saving for our retirement? Are we trying to create a plan where we want to add some ways to create more legacy for the next generation? Different ways you can set up your retirement plan or your financial plan where you take advantage of the tax strategies of these different buckets. And so, unfortunately, what I'd like to tell you is there's just one simple way to set up a retirement plan or your financial plan and get tax benefits on every side, right? I would love to tell you that I could create this tax perfect plan where the contributions you put towards retirement are tax deductible. And then the accumulation as the money's growing grows tax deferred. You don't pay when the money's growing. And when you take the money out in retirement or whenever the goal is, it's tax free. So we get a deduction up front. It grows tax deferred. You take it out tax free. That's called the tax perfect plan. The only problem with the tax perfect plan is that if I set it up for you, not only would I go to jail, you would go to jail with me. You can't have a tax perfect plan. All right, the government's going to try to collect taxes on one end or the other. They're either going to take it up front or they're going to take it out when you start taking distributions. And so when you think about that, when we start building plans, do we want either the tax deductions up front or do we want tax-free income on the back end? So things like traditional IRAs, 401ks, pension plans, profit sharing plans, you're getting deductions up front, but when you take the income out, you're going to pay taxes. Or you could think about Roth IRAs, Roth 401ks, municipal bonds, cash value life insurance. Those are places where you pay taxes today, but you're going to get the money to grow outside the tax system for the rest of your life. And so what we decide with each client we deal with, and on each goal they're saving for, where is the tax benefit most necessary? Where is it most beneficial for every family? We not only want to diversify a strategy, again, with how much risk we take in the stock market and how much is growing safe and guaranteed, we also talk about strategies that have tax diversification as well. And so again, when you go through Roth IRAs, great strategy for retirement, 529, great strategies for college planning, but then you could also use on top of those cash value life insurance, because you have the ability in cash value life insurance to take money out for both college and or retirement tax-free. But if you don't take the money out of the cash value life insurance during your lifetime, the death benefit goes to your beneficiaries tax-free. And so one of the other things you can tie into with the life insurance as well, what happens if you need the money during your lifetime? Again, tax advantages, but you can tie in additional features that says, well, if I become disabled, you can have the insurance company actually pay the premiums to the life insurance policy for you. And so the policy can build up. Now, ultimately, when we get to retirement, what we want to talk right here, and I think this is a slide I'm going to stay on for a few minutes, which is what's the purpose of the tax diversification? So let's talk about a client gets to retirement and they have a goal of $100,000 of income in retirement. Now, let's say on the left side here, we go without a tax diversification strategy. They've saved up, they've used what most people save, 401k plan, IRA, that's where they've saved for retirement. When they get to retirement, though, they've gotten their deductions as they put money away, but when they get to retirement, they're going to pull $100,000 out of their 401k plan. It's all taxable. And if we use a 22% overall tax bracket here, they pay $22,000 in expenses, or I'm sorry, in taxes. So I take $100,000 out, I pay 22% in taxes. I'm left with $78,000 of after-tax money. That's what I get to spend. My family does not care what my pre-tax income is. They only care what my after-tax income is, because that's what we get to spend and enjoy. So in this situation, $78,000 after taxes. But what about had I done a different type of planning where I use some tax diversification? So on the one side, I'm going to take $100,000 of income. I'm going to take $50,000 out of my 401k plan. And I'm going to take the other $50,000 out of either a Roth IRA or cash value life insurance. So when I pull that $100,000 of income out, everything that came out of the 401k plan is fully taxable. Everything that came out of that tax-free bucket is not taxable. So when the government says, well, how much is John's tax income? It's based only on the $50,000 that came out of the 401k. So that puts me in a lower tax bracket. So I'm in a lower tax bracket and we're only taxing the money that came out of the 401k. So $50,000 comes out of the 401k, but I'm only paying a total of 12% of total taxes. So I'm losing $6,000 to taxes on that $50,000. The other $50,000 I'm pulling from a tax-free bucket. So I'm paying zero in taxes. So the same $100,000 of income using a tax diversified strategy leaves me with $94,000 to spend in retirement. And so when we talk about what's the benefits to using a tax diversified strategy, it not only creates some of our retirement income to be tax-free, but it also means what is taxable is going to be in a lower tax bracket because less of our income is taxable. And this becomes more and more important if tax rates are going up in the future. We're, again, I've said it a few times, we're a country that's $30 trillion in debt. How does that debt get paid off? Hopefully some of it means less government spending, but to be honest, some of it might have to come from tax rates going up. If that's the case, tax rates are going up in the future. Do we want to create a bucket, whether that's a bucket for college or retirement or legacy planning for our kids, to come out tax-free? That when that money is sent out, it can come out on a tax-free basis. So you can use Roth IRAs and 529 plans, but we also use whole life insurance as another feature as part of a financial plan. Why the life insurance? Because the life insurance says, if I were to pass away before I reached my financial goal, so whether that's to pay my kids' college or my own retirement, death benefits paid to my beneficiaries. But if I do reach the financial goal, college planning or retirement, I could take money out tax-free. But if I don't need that money during my retirement or during college, I leave the death benefit behind to my beneficiaries tax-free. And so we use companies, Lakshmi and I both work very closely with a company, New York Life, with the highest financial strength ratings. We also work with many other insurance companies as well to find the best life insurance policies, whether that's term or whole life insurance. But we use the best companies to create tax-free income and set policies up correctly so that you are able to pull money out tax-free during your lifetime. And so as we add things like Roth IRAs and 529s and life insurance to an overall financial plan, what we're trying to figure out is, are we protecting our families as we're accumulating assets? And are we distributing those assets on the smartest tax strategy we can? And so as we go about this, as I've mentioned from the beginning, every family is different. Some families are just starting out, maybe saving for their first house. Some families are a week away from retirement. Some families are in retirement. Everybody's in a different spectrum. Everybody has a different goal. Some people think it's important that they cover their kids' entire college tuition. Other people, might put a certain dollar amount away. Other people say, hey, my kids should pay for my own or their own education, right? Some people have different goals of what their retirement looks like. What we always talk about from a financial plan, it all starts with goals. If I'm going to give up spending $1 today and I'm going to save it for the future, I want to know what I'm saving it for. What does my retirement look like? Sometimes it's easier to picture our retirement when we're in, I'm in Pennsylvania, you're all in New Jersey, or most of you are in New Jersey, I believe. But during those cold winter months, we could really start to imagine what life's going to look like in retirement, traveling to warmer climates, things like that. What are our goals? What are our goals for our kids and our families? Then we want to prioritize those goals. And then what we want to do, most importantly, is to create a strategy. How do we make sure that every dollar I saved, I can take advantage of deductions when they're available, but also create a strategy that gets money to grow outside the tax system for later on? And then once you create that strategy and you put it into place, the strategy is not over. What has to happen is we have to update and review up until the time we reach that goal. And so, things change, just like the stock market changed in the last few weeks here. Again, there's going to be changes possibly to government programs. How do those types of changes impact the strategy you have in place? And how do we make changes to make sure, hey, we're not taking too much risk or not enough risk to reach our goals? And so the update and review is as important as any other part of the overall financial planning process. And so, what Lakshmi and I take great pride in is meeting with clients, understanding that every client, every family is unique, every person is unique, and every financial plan is unique. Does things like Roth IRAs or 529s or cash value life insurance make sense for you and your family? Does setting up profit sharing plans? Are you a small business owner? SEP simple plans for smaller businesses. What are the ways we can get a business or an individual as many deductions today as we can? And then what do we do with older, retirement plans from previous companies? Those are all things we help develop as far as the overall plan and make sure the protection is there right from the beginning so that any concerns or anything that comes up along the way, families are protected in case things happen early on. But families are able to prosper if we live to our retirement and a long and healthy retirement as well. And so what I wanted to do is again, thank everybody for jumping on today's Zoom meeting. We truly appreciate you taking the time. We know, sometimes a lot of information could come on all at once. But if anybody has any questions, I will take a deep breath here. Certainly, we'll answer any questions. You can type them in, or I don't know if you can come off mute and ask them. But we'll be certain to answer every question you have. But I'll take a deep breath here and just see if anybody has questions.
John.
Yes.
Yeah, maybe like lots of people may have this question, like how to start protecting family. What is the best strategy to start with? Because there are so many uncertainties like for our life, and we don't know what is tomorrow, and what is the best way of starting something, and how to plan it in the future. For example, short term, long term, and retirement. How that works.
Yeah, no, it's a great question, right? Whether it's starting a financial plan or if I start a plan to go to the gym and lose weight and get in better shape, right? The hardest step is the first step, right? And so as we go through from a financial plan, the early stages of the planning goes in a few different ways. What we typically do is we recommend people get $1,000 into what we call an emergency account. So we try to put $1,000 into a savings account. That way, any financial disruption comes along, we want to make sure we're starting to build up an emergency account. So whether that's a leak in the roof, I lose my job for 4 or 5 weeks, things like that, we want to have an emergency account set up. We want to, if you work for an employer who offers a 401k or a retirement plan, is to contribute at least up to the match of what the employer offers. And step 3 in the early stage, we also want to do is what we call the protection step, which says if something is going to happen to me tomorrow, I want to make sure before my plan gets going, I want to make sure my family's protected. And typically what we'll do there is talk about disability insurance, but also life insurance. Typically with what we call a term insurance policy, it's the cheapest way. So emergency account, make sure you have, you're contributing to get the match in retirement plans, and then the term life insurance to get the protection started. Once that base is set up, then what we do is we start to build off of that for overall goal planning. So once we know we have the base set up, then what we're going to do is start to look at from a goal standpoint, okay, I'm 35 years old, I want to retire by the time I'm 60, and I want to live off $100,000 a year. How much more am I going to have to contribute in my plan to get to that goal? And that's where Lakshmi and I could sit down with somebody and say, okay, this is how much you need to put away each month to have the right chance to get to your goal. And these are the places you should be saving your money. Again, is it a Roth IRA, 529s, the different types of accounts? We would customize those from a plan. But step 1, I believe, is the question. Step 1, emergency account setup, term life insurance for protection, and then contributing to them at least to what your employer is matching in your retirement account.
Hi, John.
Hey.
Thanks for that. And this is Kumar Uchkuri. You said in the middle, you represent some other companies too. What are the other companies other than New York Life you represent?
Yeah, so there's hundreds of life insurance companies. We'll start with what we call mutual life insurance companies. So a mutual life insurance company is a company that is owned by its policyholders. We tend to favor towards mutual insurance companies, especially for cash value life insurance, because the growth of the policies is based on the growth of the financial strength of the company. So New York Life, Mass Mutual, Northwestern, Penn Mutual. There's multiple companies that are mutual insurance companies that are owned by its policyholders. Those, from a cash value life insurance standpoint, is more of a focus of where we go. If you're looking for cheaper terms, sometimes we'll go to stock insurance companies as well. There's hundreds of different stock insurance companies. Certainly the mutual insurance companies offer term insurance, but we tend to favor mutual insurance companies when it comes to any sort of permanent life insurance.
Okay. Thank
Hey,
you.
thanks, John. There are few questions in the chat as well. I
Okay,
can read out and then you can answer it.
that'd be
What
great.
what is the difference between IUL and Roth IRA? Which is the best and why?
Between what was the first one in a Roth IRA?
Be- Between IUL and Roth IRA.
Okay, so Roth IRA is just the name of an account, and I get to choose what investments I put into the Roth IRA. So Roth IRA is a retirement account. After tax money goes in, the money grows, and when I get to retirement, I can pull it out tax free. I can invest inside the Roth IRA. I can buy individual stocks. I can buy annuities. I could buy mutual funds. I could put different types of investments depending on how aggressive I want to be. The money will come out tax free as long as it's it's been in the account for at least 5 years. Now, Roth IRA, one of the negatives to it is there's income tax limits. So people making over a certain amount, and it depends on if you're single or married, can't contribute to Roth IRAs. So for people making over a certain amount, Roth IRAs may not be available. IUL is just a different type of permanent cash value life insurance. So we also said cash value life insurance, after tax money goes in, just like a Roth IRA. And if it's set up correctly, and this is a very important point, if it's set up correctly, you can take money out tax free in retirement. Now, with a cash value life insurance policy, just like IUL is one of the types, you have to pay premiums every month into those policies. So you got to build up you have premiums that are required each month. So Roth IRA, I have options as far as how much I want to put in cash value life insurance, IUL, you're going to have requirements as far as how much you have to put in. Indexed IUL is basically saying we're going to put some money in the market. If the market does very well, we don't get all of the market returns. We're capped on the upside, but in an IUL, there's some downside protection. So IUL is, do I want the money to grow based on the market, or do I want it to grow in a fixed rate? IUL is a little bit of both. There's some issues with IUL as far as how much is actually guaranteed versus how much you lose on the upside for whatever's guaranteed. But IUL is a cash value life insurance product. If set up correctly, can create tax-free income similar to a Roth IRA, just like all the other cash value life insurance policies.
Thanks, John. Thank you so much for your
But
explanation.
on top of it, actually, one more benefit, right, John? Like on top of it, like if it is IUL, you get life insurance also, which Roth IRA doesn't provide.
Yes, I'm sorry. That's a great point, right? So cash value life insurance, a couple of things, right? So you have, with cash value life insurance, you have life insurance protection on day one, right? So there's a couple different types of cash value life insurance. Indexed universal life, IUL. There's whole life, there's variable life, and then there's universal life. So there's 4 different types. You get life insurance protection on day one, and if the death benefit's paid out, it's tax-free. And if you take money out during retirement, but there's still death benefit on the back end, the death benefit still goes tax-free to your family. So all the life insurance policies have the ability to create the life insurance protection and the tax-free income. The difference between the different types of cash value life insurance, whole life has guaranteed growth, variable life has market-based growth, IUL has a little bit of each. It doesn't have as good of upside as variable. It doesn't have as good as guarantees as whole life. It tries to be somewhere in the middle.
Thanks, John. And there is a few more questions.
Sure.
Can we move IUL from one company to other company?
You can move, so you're allowed to move life insurance policies from, let's say, you can move one life insurance policy from one company to another. The answer is yes. However, it's really important to understand with life insurance, and this is whether it's whole life or IUL or any type of life insurance, in the early years, the cash value is not great. And so to stop a policy at one company after 2 or 3 years and then transfer and what we call a 1035 exchange. We move it to another company. We start back at step one. And so what we want to do is the answer is yes, you can, but you really want to study if it is in your best interest to make the change. Because again, cash value doesn't grow as quickly in the first few years, and you're starting over at step one when you switch companies. So you can do it. It's just very important that you study why you're making the change and is the change in your best interest.
Thanks, John.
Yep.
And there are a few more questions. Is it beneficial to open life insurance when you have few years to retire?
Depends on what the purpose of the life insurance is. If the life insurance benefit is the death benefit, if we're trying to leave a permanent death benefit, so I want to leave money tax-free to my family, it can be very beneficial, assuming you don't need that money for your own retirement income. It's hard to make the growth, as I just mentioned before, it takes a few years for the cash value to grow inside a permanent policy. So if I'm 2 years away from retirement and I want to build money inside an insurance policy so that I could start taking the money out 2 years before 2 years into retirement, there might not be enough time to get the growth in there. So just depends on what you're using the insurance for. If you're using it for the death benefit, it's probably a good idea. If you're using it for the cash value, it's a case-by-case situation, but that's a little trickier because you're very close to retirement.
Okay, but it is allowed to have the insurance.
Sure, absolutely. Yeah.
Thank you. And there's 2 more questions. They directly sent it to me.
Okay.
IUL versus VUL. What is best? Roth IRA versus IRA. What is the preferable?
Okay. So let's start with IUL versus VUL. So in a VUL, there's in a life insurance, permanent life insurance policy, cash value life insurance, there is growth of the cash value. So the question becomes, how do I want the money to grow? Do I want it to grow guaranteed? Do I want to know that every year the account's going to grow by 3, 4, 5% a year? That's a whole life policy that has guaranteed growth tied to it. Okay. So the great part is in a whole life policy, you can build policies where you only have to pay for a certain number of years and the insurance will stay in force because everything around it is guaranteed. And that's the beauty of it. The downside to a whole life policy is that you're never going to get the cash value to grow by 8, 9, 10% in a given year. If you want to try to get your cash value to grow 8, 9, 10% a year, you would use a VUL policy. That cash value grows based on how the market does. Now, unfortunately, this year, that cash value could actually lose money in a VUL. So if you're in a VUL and the market goes down, you can lose money in your cash value. So do I want to take risk of that cash value to get better growth? Because the markets over time typically do better. But there are years like this year where you can lose money. So whole life has the best guarantees. VUL has the best upside. What IUL does is it tries to say, well, we'll give you returns that can be market-based, but you can't get all of the market-based returns. So if the market returns 20% in a year, they'll cap you at a lower rate. But if the market is negative, they'll give you a 0% rate of return. So over the long term, the IUL can look very similar to a whole life contract as far as overall rates of return. Just doesn't give you as good of a guarantee. The upside's a little bit higher without the guarantee of a whole life. So there's you have your whole life's got the best guarantees. VUL gives you the most upside, and then IUL tries to be somewhere in the middle. As far as Roth IRA versus traditional IRA, again, the big difference is traditional IRA gets you the deduction up front and you pay taxes when you take the money out. Roth IRA is I pay taxes on the money up front, but I get to take the money out in retirement tax-free. So just a matter of where you think tax rates are going, how much income you're going to get in retirement compared to how much income you make today. That's usually the way we do comparisons, Roth IRA versus traditional.
Thank you. Thank you so much. And there is a one more question.
Okay.
529 plan. If I take it for the education, so is that allowed for all the institutional or only certain institutions allowed?
So all higher if you're talking about colleges and university, you're going to be able to take the money out tax-free. So 529 plans, very popular for college. I save money for my child's education. They go to college. I can take the money out, and the money I take out, almost like a Roth IRA or cash value life insurance, it comes out tax-free. So that's a benefit to a 529 plan. And that could be tuition, that could be room and board, that could be paying for an apartment at college, right? So my daughter goes now, her meal plan, if I take money out of the 529 to pay the meal plan, that's a tax-free withdrawal from the 529. So as long as it's used for higher education qualified expenses, the money will come out tax-free. Problem to a 529 plan is, what if I don't use it for college? So if my daughter gets to the end of her 4 years and I have $25,000 left over in her 529 plan, if I have some choices where I could then take her money and give it to her brother. That is one way to avoid taxes. I move it to his 529 plan. That works. I could, with certain limits, create a Roth IRA for her and move that for $25,000 is the limit there. But if I take the money out and use it for any other expense other than college education, I'm not only going to pay income tax on that gain, but I also pay a 10% penalty. And so 529 is a great place to put away for college, assuming you use it for college. If you use it for other expenses, very bad place to put money away.
I think he's asking, does all the universities allow to pay college fees from 529 plan? Or
Yes.
is there any restriction?
No, so the universities will not restrict you. And again, really, you're going to pull the money out. The 529 company typically will send you the money and you're going to pay the university from that. So the very few restrictions on, you could use it for law school, medical school. You could use it for trade schools even. So you have options as far as what you use the 529 plan for.
Thanks, John. And the same person just now posted one more question.
Sure.
So the 529 plan, so in other way, it will give the tax benefits instead of pay upfront to 20-30%. So in case if I don't use, I can take that amount paying at 10%. Is that right?
So if I let's say over the next 10 years, I save, I put 20,000 of my own dollars away for college in a 529, and by the time my kids are college age, that 20,000 has grown to 50. So I have $30,000 of gain. If my child decides not to go to college, or maybe they get a scholarship and they don't need the money, and I say, okay, I'm going to take that 50,000 and I'm going to go on a trip around the world because I didn't need that money for college. I'm going to use it, or I'm going to buy a house, or I'm going to use it for some other purpose. The $30,000 of gain, I have to pay income tax on, and I have to pay an additional 10% penalty on that because I did not use the money for college education.
So, John,
So
can I
taxes and penalty.
John, can I add something on that? This is again Kumar Utpuri.
Sure.
So again, there is the 529. A lot of confusions are there. People think that it's totally tax beneficial. So it's only the state. There is a deduction from the state. There is no federal taxes, right? So that.
Yeah. So yeah. Let's clarify that. So what I'm talking about is when you take money out of the account, you don't have to pay federal or state income tax on the withdrawal. So I've saved money every year. I get to college, my child's in college, I take money out to pay the tuition. That avoids income taxes when I take money out of the account. Your question there is, when I first put money into the account, do I get to get a deduction from my state or federal taxes? The answer to that is it depends on your state. There's no federal deduction when I put money in. Some states will give me a deduction. So every state is a little bit different. So I don't want to blanket that and say it's definitely a state tax deduction. But your contribution, when you first put money into the plan, some states will give you a deduction on your state income tax for that.
Yeah, absolutely. That's what I wanted to say, that there is no federal taxes. A lot of people get confused that there is a federal tax also. They can save. That's what I was trying to say.
Yeah, there's no deduction from the federal side on what you put into the plan. But again, once your child reaches college age, when you take money out, you don't have to pay federal income or state income tax on that when you take the withdrawal out.
Right.
Yeah.
Okay. And I got, while you were explaining, John, two more questions.
Great.
One is a 529 plan can be used to pay for out-of-state colleges.
Yes. Yeah, they absolutely can. If we want to get technical and we want to do a second session just on college planning, we can get into like a lot of details. There's technically two 529 plans. There's what's called prepaid tuition. And then there's also what's called just a 529 savings plan. So prepaid tuition means I pay a state and I'm basically buying credits for a state university ahead of time. That some states offer, and that's just for in-state. Most people use what's called the 529 savings account, which is just I put money into a 529 savings account. That money grows based on the mutual funds that we're investing in inside of it, and I could use that money in for any whether it's in-state or out of state or even private colleges. So 529s for the most, but yes, you can use it for any state, in-state or out-of-state tuition.
Thanks, John. And the last question, if I have 529 for two kids, can I use total amount for one child and not on both? And what happens if I end up not using on both kids?
So that means you're playing favorites. We're going to use the money on one child and not the other.
Yeah, so I think partially you answered before. Yeah,
I won't tell the second child you did that, but no. So a very, very common question. So I myself have two kids. So I have my daughter who's currently in college at Penn State, and I have a son who's in high school. So if by chance I did not have enough money in her 529 plan, you can transfer money between your children from one 529 account to the other. So I could take money from his 529 and move it up to hers to help pay for her tuition, and vice versa. So if she gets to the end of her 4 years and there's some money left over, I can slide it down. I can move it to his 529. So you can move money from 529s between children in the same household. And it expands a little further than that, but very simplistically, I can move money between the kids in my household between their 529 plans. But if I have money for my daughter, we use her 529 plan, there's a little money left over, I leave it to my son. Now he's got money in his 529 plan. He's my last child. If he gets done with college and there's still, let's say, $40,000 left over in his 529 plan, there's a new rule that allows us to set up a Roth IRA, move the money from $25,000 from his 529 into a Roth IRA for him if I wanted to set that up. But if I just wanted to take that money out and I could say, hey, I saved the money for the kids' college, I've paid their tuition, there's $40,000 left over, I'm going to take that money out and use it maybe to pay off my mortgage, or maybe I'm going to pay off a loan I have, whether it's my mortgage or a car loan, or I want to go travel and enjoy the money. If I take the money out for anything other than college expenses, again, I pay income tax on the gain and I pay a 10% penalty. So we can shift money between kids. Once we can also set up a Roth IRA for the kids up to certain limits, but then if the money's used for any other reason, we're going to pay taxes and a penalty.
Yeah, thanks, John. This is really very helpful. I think just we'll open for last one question. Anybody have any questions? So we can close it. Thanks, John, and thanks, Lakshmi Garu. Lakshmi Garu, you wanted to add anything?
Yeah, thank you so much for everyone for joining. John, I really appreciate your time and a lot of valuable information. So even though I have good experience, but you have even more experience than me, so I would like to use your expertise to be beneficial to the community. And thank you so much, Marta, for giving us this opportunity. And yes, definitely a lot of people has questions on different topics, but so as John said, we cannot cover all the topics in one session. So with Marta help, we will be having ongoing sessions in future, and definitely we'll be able to help you with a lot more information. And John and I, we work on cases, on people's financial planning and individually, and we sit together and we set up a plan, or we do some strategies based on their financial goals, health, and based on their kids' goals, education goals. A lot of things comes into the place when we do financial planning individually. So we will be happy to help if you have any questions or anything, or if you would like to talk to us, we will be happy to help you with any of your financial planning. And thank you so much, everyone who has joined today.
Yeah, actually, I would like to add one another thing. This is very good. This is covered so many things, but I think we should have specific sessions to cover this 529 college plans and term insurance, how to effectively use term insurance and layered insurances, and full life insurances, and any other plans, particular sessions to cover those topics, so that people understand how to mix and match and come up with the proper plans for their whole set of requirements. So I think those are the other things we should do in the future, and that may make it more useful to everybody, because I don't think just 1 hour is enough to cover all the aspects of this whole protection and insurance and everything. So we should really try to do specific topics in the future.
That's a great point. And if people want to give feedback and say, hey, we'd love to learn more about 529s or different ways to save for college, we could do a whole hour on that. If you want to do term versus whole life versus IUL, what are the differences in life insurance? We dive in for an hour on that topic. If there are topics you're interested in, we'd love to cover them. If anybody has specific questions on their own situation, Lakshmi's contact information is right here on the screen, so we could take those questions offline as well. So yeah, we're happy to help out in any future sessions. And if there's specific topics you want covered, we'd be glad to do it.
Yeah, and we have services from basic life insurance to advanced planning and estate planning based on the client situations. So we have a wonderful team in each and every area who we can help individually. Thank you so much. Please reach out if you have any questions. Yes, you can reach out to us offline also.
Thank you, Lakshmi Garu. Thank you, John.
Thanks, everyone.
Yeah, Kiran Garu, anything wanted?
No, we are good actually. So this is one of the financial planning session. 2 months back, we had a tax planning session. We have a renowned tax specialist. So that's Anil Gandhikaru, who has also joined this call. So we're going to schedule Anil Garu has joined this call as well. So John Begley. So Anil Gandhi is the renowned tax specialist. So we had a session with the tax specialist Anil Gandhikaru in the past. So we'll be having another session. Mata will provide all such information sessions to most of our community so that they can get benefit. Thank you, Anil Gandhikaru. Thank you, John. Thank you, Lakshmi Garu, everyone for helping the community, Mata community. Thanks a lot.
Thanks, John. Thanks, John, for a great session. And thanks, Lakshmi Garu, for coordinating all this and sharing a lot of your knowledge with the community. It's great to see. And of course, thanks to Praveen Guduru.
Thank you. Thanks for joining.
Thanks for joining, Andy. Anil Garu.
Yeah. Thank you, sir. Yeah, thank you.
Bye.
A lot of learnings. Always learning. A lot of learning from John. Thank you.
Thank you.
Thank you, sir.
Thanks, everyone. Thank you. Bye.
Thank you.
Bye.
Good night.